Financialisation as a topic, as a study, has been pioneered at the University of Manchester by colleagues within the business school. Part of the argument is that financialisation has impacted all levels of the economy and society, including the household. So these next set of slides deal with financialisation and the household specifically. So here's the first slide. And as we've done in the past, let's first look at it and describe it, and then we'll see whether or not we can interpret it. Okay, so the first thing that you'll notice is that there's two charts on this particular slide. The one on the left shows gross financial assets, and you can see from the gold bars, if you like, is that gross financial assets for households have been going steadily up over the period from that's shown on the graph, 2008 onwards. 2008 through 2009-10, dramatic increase in growth, which is set out by the green line on that particular chart. More latterly, 2017-2018, is that there's been a decline in the growth of financial assets in households. But actually, I just this morning downloaded the Alliance 2020 report, and I can tell you is that financial assets have recovered quite considerably in terms of those that have been purchased by households, and there's been a dramatic shift and a dramatic increase. So the market, if you like, has recovered quite dramatically. So that's the first thing that we might notice from this. The second thing is, if we look at the four bars on the right hand side, is that the brown one is showing the gross financial assets, which is about 172 trillion euros, which is dramatically more than output, global output. And then the three columns next to it show market. The first one, the blue one, shows market capitalization, and that's basically stock markets. So that's the total stock markets against the amount of household assets, financial assets. So you can see there's about 3 times different. So the amount of assets that households hold is approximately 3 times bigger than market cap. But people don't really talk about households, do they, and household assets. They talk predominantly about the size of the stock markets, and yet we really ought to focus upon what the households are doing, even if it's just because of the size of the actual assets that have been accumulated over time. So next to the blue column, we've got the purple one, and the purple one is showing us the size of global output. And again, the size of household assets is dramatically larger than the goods and services that's being produced by the globe. And then moving along, we'll look at the sort of like the grey-blue one at the end there. I'm not quite sure what colour that is. But that's the size of sovereign debt. Sovereign debt is the debt that's been held by sovereigns, countries. In other words, so it's public debt, government debt, expressed in terms of sovereign debt. But that's smaller than the other 2 columns. So even if you were to add up all of those 3, sovereign debt, market cap, global output, it's still not the size of the financial assets that's held by households. Now, there's an awful lot of focus, isn't there, on 3 of those 4 columns anyway. There's an awful lot of focus on global output and whether economies are growing or slowing down. There's an awful lot of focus on the size of stock markets, and the growth of stock markets and share prices generally. And more recently, there's an awful lot of focus on sovereign debt, public debt, particularly in the light of COVID and the response to COVID. Public debt has grown quite dramatically. But there's very little focus upon household assets and how householders are acquiring those assets and how they're paying for them. And given the relative size of household assets to the other 3 columns in there, is that where is the risk or the potential risk, where does it reside? Stock market, sovereign debt, global output, or does it reside within the assets that are being held and generated or being purchased by householders? So let's look at the next slide. Again, you've got two charts on the same slide. The one on the left, which is the purple bars, shows you the growth and otherwise of the various financial classes, the assets that we've been talking about. And you can see that they're broken down into three different kinds: insurances and pensions, securities, and bank deposits. And what you can see is there's quite a dramatic decline in householders investing in securities, and that's being compensated for by more people holding money at bank. The chart on the right hand side is not particularly interesting, I don't think, because all that's showing you is how that's been that's the various makeup of the proportion of the various asset classes that are being held by people. But I think the title sort of like gives it away here, is it? Because we sort of like they hold risky assets. Now, what we mean by that is that when you buy a insurance or a pension particularly, is that you might invest in the pension, but you don't really know what return that you're going to get. That's down to your pension manager or the fund manager. Similarly, when you invest in securities, is that you don't know, unless you've been able to buy bonds directly, which is a fixed income security, and therefore you'd know what the return that you're going to get there, but you'd have to be pretty wealthy to be able to afford bonds. Mostly people invest in securities through buying shares or invest in funds, but they do it through an intermediary. And so you're very much reliant again upon the skills of the intermediary. So you're investing your money, but you don't really know what you're getting out of it. So there's a risk there to the householders. Now, pension managers and fund managers, they make money out of householders. The risk, therefore, has effectively been passed back to the householder rather than the fund managers. Pension and fund managers make money on the size of the fund, and they'll take say a 2% fee, management fee, administrative fee for managing a fund. So let's assume that the size of the fund is £1 billion or $1 billion. 2% of that would be a management fee. Similarly, if they make money on that fund, which you would therefore benefit from, is that they would take 20% of that as well. So, but if you looked at it and you think about it, is that actually fund managers will make more money through increasing the size of the fund than they would do through making returns on it. So if we took our $1 billion fund and then we increase that to 2 billion through marketing, retailing, etc., we'd make quite a lot of money. But actually, if we made an additional 1% because of on the size of the fund in terms of returns of the fund, we'd take 20% of that. So there's a risk there again to the householder, isn't there? So there's one risk in terms of the fact that you don't know what your return that you might be getting. You're reliant upon the intermediary. The other one is that the intermediary is really focused upon increasing the size of the fund. And then the final one is that all of these assets depend upon people continuing to pay into them. Well, if there's a change or if there's a shift in the economy, the performance of the economy, let's say that the economy goes into recession like now and people start to people start to lose their jobs, then that puts at risk the assets that people have been investing in, because you don't have the money to continue to make the payments on it. And so there's a risk there that you could lose your money. But there's also an additional risk because of the fact that in many respects, funds that householders have been paying into have been securitized and turned into derivatives. And so those derivatives will fail as well. And I will talk more about that later on when we go back to the online materials. So moving on then, let's have a look at this one. And this chart is showing us the relative distribution of financial assets across the globe. And you can see here, I mean, basically the size of the blue balloon is indicative of the size of the assets in that particular country, and you can see that the size, basically North America has got the biggest bubble or the biggest balloons. That's where all the assets are. And then after that is Western Europe, and then you go over to the other side of the chart, and then you've got Asia, which is excluding Japan, which is basically it's China. Is that the financial assets that are held outside of China in Asia is negligible, really. But I think what's interesting about this is that economists are telling us that the growth is in emerging markets, and it is. You know, GDP growth is all in emerging markets. GDP growth in the industrial powerhouses of Japan, Western Europe, and North America is moribund at best. But that's where the wealth is, and that's an interesting paradox, isn't it? In that the wealth is being held in those old industrial areas, production, the old manufacturing powerhouses, if you like, the old industrial, the old economic powerhouses, if you like. That's where the wealth is being held, but that's not where the economic growth is being held, and that's sort of like, it seems to be contradictory or counterintuitive to me. As if to make the point, here's a chart that shows GDP and the proportion of GDP that's delivered in various parts of the world. You'll have noticed that actually, if you add up all of those charts, you get more than 100%. Well, that's because this has been adjusted to what's referred to as purchasing power parity, which broadly speaking means that what you're trying to do is you're trying to equate people's capacity to be able to buy something in a particular country. So you're using statistical measures to try and level everything up. So even though it's over 100%, I think what's more important is probably the relative sort of like distribution of it. And you can see from here is that actually the largest share of GDP is in emerging markets, quite considerably more than advanced economies. And that, once you've got outside of the advanced economies, is that it drops off pretty quickly. And yet, even though the GDP, the productive stuff, the making of the bulk of making goods and services is happening in the advanced, in the emerging markets, is that household wealth, along with the assets, of course, is in the aging old capitalist countries. That's a much better expression than the one that I used before. And again, you see the bulk of it is in North America, where households are very affluent. Then Western Europe, Japan, more so than Western Europe. Oceania, which is frankly is just is Australia and New Zealand. I used to think Singapore was included in that, but it's not. It's just Australia and New Zealand. And a lot of this is as a consequence of property ownership, as well as other wealth management products that people are holding. But if you compare Asia, it's quite small, relatively speaking, to the others. So there's a strange sort of. Well, I think that what it does is indicative of what I said elsewhere on the materials. Is that we have two distinct economies. We have a financial economy, and then there's a productive economy of goods and services. And whilst the West, the old industrial countries, are investing in wealth products in the financial economy and buying their goods and services from the emerging markets is existing not entirely and not exclusively, but to a greater extent in products and services. And I've put this slide in so we can make a comparison, I think. But it gives credibility to the reason why a lot of the wealth is existing in North America. Because if you go down this list, and these are asset management companies, the largest asset management companies, and they're all in America and Europe. You know, so there's a correlation there, isn't there? Is that, you know, there's more opportunity to invest your money and increase your wealth. So here's an interesting provocation for you. If you look at this chart, is that you can see right at the top there's a company called BlackRock. Now the number that they're at the end of that column, 6.52, is trillions of dollars. So the size of the fund that BlackRock have got is $6.5 trillion. Now, that's pretty large, isn't it? But as you said, and remember I said earlier on, is this is how fund managers make the money. So they'll be taking, the BlackRock probably won't be taking 2% of 6.5 trillion, but they're certainly going to be taking more than 1%. And they'll be paying that to themselves as a fee on an annual basis. That's a staggering amount of money. If you aggregate all of those up, and then you can see from that how much fund managers are paying themselves. But it's not necessarily, they're not paying themselves for their competence in increasing the size of the fund for their fund holders. Is that they're paying themselves, broadly speaking, for their ability to be able to increase the size of the fund by getting more people to invest in it, which is a retail and a marketing exercise, which I find quite interesting. And here's another little factor, is that there is a view that China holds such a significant amount of American debt that should China decide to sell all of that debt, it would sink the economy of America. You might have heard this before. Frankly, it's nonsense. Is that, for one thing, is that China is not the world's largest holder of American debt. That's Japan. Japan has always been the holder of American debt, and the size of the size of Chinese Chinese purchases of American bonds. So there's a couple of things to note here, isn't there? Is that one is that if you buy a bond, then you're earning an income from it. So broadly speaking, is that China is earning an income from America in bonds, through its bonds in dollars, and it'll need dollars in order to buy oil, corn, soy, or whatever commodities it wants to buy on spot markets and open markets, commodity markets across the globe. And it holds around about. So if it's holding those bonds and it's making an income, why would it sell it? Because it's pretty damn secure, isn't it? And then the other thing is that the size of the actual their investments or their holdings is about $2 trillion, and it's $2 trillion worth of bonds. And if they were to sell this onto the open market, what would happen? Well, people would buy them, frankly, because it's American debt. And it's about the most secure debt you could buy on the planet. So they're highly unlikely to dump it. But actually, relatively speaking to the size of the debt that China is holding, relatively speaking to the amount that probably BlackRock is holding, is that BlackRock are holding 6.5 trillion, which is 3 times the size of Chinese debt. But nobody talks about what would happen if all of these fund management companies decided to sell all of their American debt. It's interesting, isn't it? There's a bit of, I don't know, what's the word? A bit of xenophobia, I think, going on there. Anyway, leave this now and go back to the online materials and do section 3. Ta-da!